Good morning, doctor.
Good morning.
Morning, doctor.
Okay, so in just a couple of minutes, we will begin with our session for today. Okay, let's begin. Let me share the slides with you. Okay, here we go. How far have we gone in chapter number 2? I think we were about to discuss some type of crisis, if I'm not wrong. We are done with these types of exchange rate, free managed, floating, free float exchange rate, pegged, and no national currency. I think we were into this part of this chapter to discuss the crisis of various countries happening because of the exchange rate, right? Or have we taken this part? We haven't discussed these crises. Am I right?
No, not as of now.
Okay, so let's begin with our today's session formally. Uh, this is where we ended last time. We said that exchange rate plays a major role in the economic stability of the country and is one of the very critical factor for the international finance for the finance manager to take care of the international matters. Whenever the business is involved in international trade, the exchange rate is definitely going to be one of the most significant element in your decision making. And there we said that exchange rate is of different types. Some exchange rates are floating exchange rate systems where the exchange rates are totally controlled by the demand and supply. Demand and supply of what, by the way? Do you know under exchange rate how the exchange rate is determined by the floating exchange rate? How the exchange rate is determined by the demand and supply? Demand and supply of what? This is a blank slide which I added. So I just want you to look at the screen for a moment. And I want to tell you that under floating and managed floating exchange rate system, how the exchange rate moves and what is the demand and supply of what. So, okay.
Goods and services provided by the
No,
company, a country.
no, not goods and services. I hope you all are looking at the screen. Have you taken any course of economics, any international economics or micro or macro or world economics, any economics course so far?
No.
No. Maybe some of you might have some background of economics. So generally, there are two laws which are very common and which they are applicable to our life. Law of supply and law of demand. Okay, what are those two laws? Law of supply and the second one is law of demand. Now, in case of law of supply, we generally, what do we observe? As the price increases, the supply increases. Do you agree with this? As the price of goods and services increases, the supply also increases. because now the supplier tried to produce more, supply more, and try to make more profit. That is called law of supply. Whereas law of demand is opposite to the law of supply. Law of demand tells us that as the price increases, the demand decreases, which is a natural phenomenon, and we all act accordingly. The moment the price of any good is higher, do you consume more or less? What is your natural tendency? When the
Yes.
price is high, you buy less, right?
Yes.
And when the price is less, you buy more. So which means that the demand of the goods and services and the price has a negative relationship. They move in opposite direction. As the price rises, the demand goes down. As the price goes down, the demand goes up. So their movement is opposite. This is called law of demand. Law of supply says their movement is not opposite because they are looking at the supply perspective. So law of supply says that the movement of the supply of goods and services and the price is positive. As the price rises, the supply of goods and services rises. And as the price falls, the supply of goods and services fall. For example, you are selling fruits and vegetables. Today the price is high. Will you supply more or less?
More.
More, because you are a producer and you want to make profit. This is the law of supply and law of demand. Now the floating exchange rate system is based on the law of supply and law of demand, which means float. It changes according to supply and demand, but not the goods and services. Here we are talking about the currency, right? And which currency do you use to measure your currency? Usually we use the dollar, right? So dollar is used to measure the currency. Let's say we are measuring against the dirham. So on x-axis, we have the quantity, and on y-axis, we have the price. Price of what? Of course, we are measuring which currency? AED, right? So now we know law of demand says that, and the law of demand shows a curve like this. This is the quantity and this is the price. So law of demand says that the relationship between the quantity and the price is negative. But law of supply says the relationship between the price and the quantity is positive. Positive means it goes upward. This is the supply and this is the demand. Now, why the demand curve is negative? For example, let me, where is the razor? I just want to erase. For example, I just want to remove this for a moment. Yeah. I want to go step by step and show you basically how this exchange rate is made. So now this is the law of demand. I said the demand curve is downward because of the negative relationship between price and the quantity. Now, if let's say this is the price level, this is the price level. If you take it to demand curve, this is the curve where it touches, and bring it down to the quantity. Bring it down to the quantity. So now if the quantity of the dollar, for example, is here, I'm putting any number, 80, the the price would be, you can say maybe 2 or 3. Come on. If the demand, sorry, if this is the demand and this will be the price, for example, this will be 60. The demand curve shows the negative relationship between the price and the, but we are talking about the currency here, not about the goods and services. But when you plot in and the supply curve shows the positive relationship, means more is the supply, more is the price, more is the supply. So here, if you just let me raise these boxes, I want to put in the supply curve and show you together actually what is happening. The supply curve is upward line because there is a positive relationship between price. If it is negative, it is downward. The exchange rate is determined at the point where the demand and supply intersect each other. This is the point. And this is how the government measure it. This is called equilibrium point, and now at this point, you can see, let me just raise other numbers. Yes, no. If at this point, it is, let's say 3, and this is, maybe you can say, okay, I can measure maybe Indian rupees. For example, it is, I'm not sure exactly what is the rate with the Indian rupees, but approximately, let's assume that it is 90 rupees against $1. So this is the exchange. Now demand, and this is the supply. If the demand rises, demand of what? Please, this is the demand of dollar and supply of dollar. The moment demand rises means the demand will move upward. So this curve will go there. What is the new? Assuming that the supply is constant. When the people demand more dollar, when the people in the country demand more dollar, what will happen? The demand will rise and the demand will move upward. Let's say this is the demand curve, D2. And again, I would say this is the demand and supply of dollars that I'm talking about, nothing else. So now when the demand, what is the new equilibrium point? New equilibrium point comes here, I mean the point where the demand and supply intersect each other. So here are they and here are they. So now what happens? The demand for the dollar rises. So let's say it becomes, now you need $2, but the price of the dollar also rises to maybe 100. The moment demand for the dollar rises, the price rises, assuming that the supply is constant. So when will the demand rises? When the import of the country rises or the export rises? When the people need more dollar, in case of more import or more exports? When the country has more imports, they need more dollar, or when they have more exports, they need more dollar?
When they import?
When they import, why do they need dollar when they import?
Because they are buying goods.
They are buying goods and they need to make payment in dollar to the foreign companies from whom they are buying the goods, right?
Yes.
So the demand for the dollar rises in case of import of the goods and services. That is why every country always try to increase the export. Because when the export rises, what happens to the, do you think export affect the demand for the dollar or supply of dollar? When you have more export, what will happen to your supply? You need more dollar will come into the country or less dollar will come into the country?
More.
More dollar will come into the country.
Yeah, so let's say this is the demand curve, the old one, and so now when the export will rise, that is why every country is always concerned about increasing the export, because the moment export rises, what happens? The moment export rises, the more dollar comes into the country. This is the supply of dollar. This is the demand of the dollar. And this was the equilibrium point, for example. Now, when the export of the country are rising, what will happen? It will affect the demand or supply of dollar. The supply of the dollar will rise. Okay, now you are selling to the foreign countries and you are getting dollar from those countries. So it will increase the supply. And when the supply increases, the supply curve will shift somewhere here, anywhere. This is the supply 2, supply of dollar. So now the new equilibrium point comes here. You can see exchange rate is determined at the point where the demand and supply intersect each other. So now here it goes. So now you can see what has happened to the price of the dollar. Now $1 or $2, maybe you can say $1.50, $1.5 is equal to how many rupees? 40 rupees. So this is what it happens in a floating exchange rate system, that it keeps on floating. And the flotation happens because of what? What causes the flotation? It is the supply of dollar and the demand of dollar. Supply is attached with what? And demand is attached with imports. So that is why every country is concerned in increasing the import and decreasing the export so that they could have more stable exchange rate. So then this is one of the very popular crises that has happened. Okay, yeah. Mexican peso crisis. Actually, what happened? Peso is the currency of Mexico. So in December 1994, the Mexican government intentionally what they did, they plan to, what is this? They plan to devalue the peso. What is devaluation? The government of the Mexico announced that they will devalue the peso against the dollar. Of course, most of the country use dollar as an international benchmark. So they said we will devalue our peso. What is devaluation? Anybody knows? What is a devaluation? Devaluation is the depreciation, okay? What is depreciation? Last time we discussed depreciation of currency. Depreciation, or it is also known as, okay, devaluation. Like what happened, what they did? Like for example, 1 peso was equal to, okay, 4 peso were equal to $1. They devalue it. What they did, they significantly devalued by 14%. So what they did, for example, 6 peso is equal to $1. This is what they did. Now this is devaluation of peso now. In peso is their currency. So devaluation of peso, which means depreciation of peso they did. This to see and change the currency traders' expectation. But why would a country do so? Why would the government intentionally devalue their currency against the dollar? What benefit they will get from it?
So that they can export more?
Why will this increase their export when their currency is cheap? Now the peso against $1, they are paying 6 peso.
Because
how will this affect the export?
The other country can buy more goods at a lower cost.
Very good. Yes, because when your currency is low, when your currency is cheap, now what the other country can do, the exporter of the importer of other country, like for example, you are selling, if you are in UAE and the UAE government today decided that we will devalue our currency. Like it is 3.67 dirham against $1, they have decided to make 5 dirham against $1. Now the person who's buying the dates or the oil from the UAE in US, for him, the goods of the UAE become cheaper and he will demand more. Because now with $1, he can buy goods equal to 5 dirham. Before he was buying with $1 goods equal to 3.67 dirham. So this makes the goods cheaper for him and he buys more good, his demand rises, and this will increase the exports of the country. And this will decrease the import, okay? You know what will happen to the import when you do the depreciation of currency? Now the imports of the UAE become more expensive because the importer is paying in terms of dollar to the foreign exporters. So like, for example, you are in UAE, you are buying cars from the US and you will have to pay in dollar. How many dirham you will have to pay in order to buy $1 from the market and send it to the exporter in US? You will have to pay 5 dirham to buy $1. So the dollar become expensive for you, which means the goods that you are buying from the other country are expensive for you because of the devaluation. So you will decrease your demand for the imports. So this is what many countries have done in the past, that the government intentionally devalue their currency against the foreign currency so that they can increase their export and they can decrease their import to improve their balance of payment, which is probably our next chapter. So this is what the government of Mexico also did. And this is called Mexican peso crisis. But what happened because of this devaluation, the international investors who invested in the peso, they got scared. They thought that peso is not going to be a stable currency. And in return, what happened? The value of the peso decreased by almost how much? 40%, because a currency is also an investment. People invest in the currency like a commodities, like the products. So when the government of the Mexico devalued the peso, the investors who invested their money in peso, they got scared. They start selling the peso and the value of the peso went down by 40%. The government tried to decrease it by how much? 14%. But in return, because of the market rumors and expectation, the currency fell by almost 40%. So this started the crisis for the government of Mexico at that time. So what happened because of the crisis? This is what it happens. Always, whenever a country goes into the crisis, what if you are an investor in Mexico during this time when they devalue their currency, what would you do to your investment? You will not shift it to any other country where the currency is more stable.
True.
So this is what happened with the Mexico at that time. They did not realize that this benefit which we are expecting, and what is the benefit? Increasing the export and decreasing the import by devaluation or depreciation of peso against the dollar. They did not expect that this can fire back, and it happened to them. The investors which were in Mexico, they start perceiving Mexican currency, which is peso, as one of the very weak currency because of the devaluation of almost how much? The devaluation was almost 40%. And as we said in our last session, that whenever you are investing in a country, the local currency is very important for your profits, because you are going to get profit in the local currency. You will convert it into dollar and send it to your head office. But if the local currency is very weak against the dollar, when you will convert it into dollar, you will get less number of dollars. And this means that in real term, your profit has gone down. So that is why this will motivate you to move your investment to any other country. So this happened that because of this peso crisis, a huge amount of portfolio investment shifted from Mexico to many other countries. So what are the lessons for us to learn from the Mexican peso crisis? That number one, it is essential to have a multinational safety net in place to safeguard the world financial system from such a crisis. So now, if a crisis happened in Mexico, do you think only Mexico would be the country that will be affected because of the crisis, or it will basically move to the other countries, or it can move to the other countries? So do you think a crisis happening in one country can affect the many other countries in the world?
Yes,
Do you
it
think?
does. Yes, it does.
And if yes, how? Can you give me an example? How this crisis in one country will move to the other countries? There are many examples. You might have heard about the international financial crisis of 2007, 8, and 9, haven't you? You have heard about the crisis. It is international financial crisis, mean almost all the countries in the world were affected. However, it started from the US. We will discuss this crisis in one of our chapters because it is one of the very important component of international financial management. And you can say one of the failure of international financial management, because of which this crisis happened, and then it went all across the world. Almost more than 100 countries were affected. So when a crisis happens in one country, it does affect other countries, at least those which are involved in trade with that country. Why? Like if you take the example of Mexico, this peso crisis, The moment Mexican currency went down, who was going to be affected? The local businesses, the domestic business. And that in the domestic business, of course, there are a lot of international companies who have invested money over there. So they will lose their money because of this crisis. When they will lose their money from Mexico, they also have investment in Brazil. They also have investment in the neighboring Argentina and many other countries, in Colombia. So don't you think they will all their investment and their business in those countries will affect, because they will take out cash from those countries to meet their cash requirement and liquidity requirement in Mexico. So if they want to sustain their position in Mexico, they will have to bring the money from other countries into the Mexico. So this will affect the business in the other countries. So this is how the moment a crisis happen in one country, because now if you take the example of UAE, you can see most of the companies around ourselves are multinational companies. So if a loss happens to, let's say, for example, the McDonald's has serious losses all across the UAE from its business operations. Don't you think this loss will affect its business in other countries? They will have to bring in the cash from other countries to sustain their business, or they will have to close it and go back to the other countries. So it will have an effect because the economies of the countries are integrated with each other. They are interlinked. So this is what had happened in Mexico. The moment the crisis happened, it went all across the other for at least 4 or 5 countries, neighboring countries who were involved in trade, like US, it was Argentina, Brazil, and some other countries, they were affected. And the flight of the capital happened to the other countries. And of course, when any one country in a particular region is affected, the investors who are investing in a portfolio, they move to other continent basically. So the investment then flew to Europe because they thought that Europe is more secure now. So you will have to be careful when you are devaluing your currency. Similarly, there was an Asian crisis, same like a Mexican peso crisis. But it was more serious than peso crisis. It happened in most of the Asian countries when they devalue their currency, just like Mexico. And the purpose was to increase the export and to decrease the import. But of course, it will definitely have some other effect on the economies of these Asian countries like Mexico. So, of course, the firms who were operating in the Asia, they were affected. Their business was affected, and in return, they were having their operations in other countries. So they will have to bring in the cash from other countries to overcome their financial liabilities in Asian countries. So the crisis went across the Asia, and this was also a currency crisis, just like the Mexican crisis. And it will have a social and economic impact, of course. Then similarly, another country which was involved in such a crisis was Argentina, which is also close to Mexico. So in 1991, the Argentinian government passed a convertibility law that linked the peso to the US dollar at a parity. So what they did, they pegged, we have taken one exchange rate system in our last lecture, which is called pegged exchange rate system, like which we have taken for 3 exchange rate: floating exchange rate, managed floating exchange rate, pegged exchange rate, and no exchange rate, mean no currency. Which of these 4 exchange rate are we applying in UAE? So which exchange rate system the UAE government is applying at the moment?
The pegged to the dollar.
Pegged to the dollar, mean it is attached to the dollar. It is not depending on the demand and supply of the dollar. The first 2 type, floating exchange rate and managed floating exchange rate, depends upon the demand and supply of dollar. And demand of the dollar depends upon the import, and supply of dollar depends upon the export. So I can say that in case of floating exchange rate and managed floating exchange rate system, the exchange rate depends upon the import and exports of the country. But the UAE did not follow that method like many other countries in the world. They pegged themselves against the exchange rate. Similarly, the Argentina also did. The currency which is used in Argentina is also peso. So they pegged the peso against the US dollar. They attach it with the US dollar. If the US dollar is rising, the peso will rise. And if the US dollar falls, the peso will fall. So it will have, because the government of the Argentina thought that this will have a positive impact on the economy, because dollar is a good currency. The moment the dollar becomes strong, the peso will become strong. And that did happen. What happened in the beginning? When they attached the peso with the dollar was rising from 1990 to 2000, the dollar was on rise. So for at least 5-6 years in the beginning, the peso value also went up, which helped the government of Argentina to control the inflation and to get more foreign investment. What happened? This helped the government of the Argentina to control the inflation and to get more foreign investment, because now the Argentina, the moment the peso strengthened because of rise in dollar, the Argentinian economy was considered as one of the stable economy, and the foreign investors from the other part of the world and from the region moved to Argentina and they started investing over there. So these were the two achievements. The government of the Argentina, because of this attachment of the peso with the dollar, was able to control inflation and to attract more foreign investment. But of course, it has some negative impact on the economy as well. Why will it have a negative impact? When the dollar appreciates, the peso also appreciates, right? The peso will become strong. But when the peso becomes too strong, what impact it can have on the economy when your currency is getting too strong? Do you think it can have a negative impact as well?
The exports would get less.
Yeah. What will happen? The export will be affected because of the reason we discussed before. What is the reason? Why the export will decrease? Because of the appreciation in the peso. And now the peso is strong and the exports of the Argentina went down. So why would this happen?
Because the currency value also will increase and the export value you have to, the people who buy from you have to pay for more for what
They
they
will have,
import
for
from you.
example, yeah, 1 peso was equal to, oh, okay, for example, 4 peso was equal to $1 because the peso was pegged with the dollar. So now the moment dollar went up, the peso also went up. Like for example, it was the moment dollar appreciate, so $1 become equal to 2 peso. So now what happened? Because of the increase in strong economy of the US, the dollar went up and the peso also becomes strong. So now because of this, if you think for the uh, exporter, now exporter when he's paying $1, he's getting goods equal to only 2 peso. Before with $1, he was buying goods equal to 4 peso. So now the goods that he's buying from you, which is called export, becomes more expensive for him. So his demand will fall, demand for your goods, which means your exports and the import of that particular country where he's buying. So this is one of the disadvantage of strong currency. The moment your currency appreciate, your exports can have an impact. And when your exports are less, what will happen to the businesses in a country? When there are less exports, do you think the people will now produce more? If your exports decreases, what will happen to the production? Production will increase or decrease?
Production will decrease and the local people who produce that are affected by this.
Yeah, and they will lose their jobs. And this is called unemployment. And when there is no unemployment at the same time, what happens? The inflation reached. How much was the inflation? 20%. So see, this was one of the biggest disadvantage when you peg your currency with a strong currency, your currency appreciates. And when your currency appreciates, your export falls. When your export will fall, your producer who is exporting the good will stop producing goods. Why will he produce? And when he will not produce, he will, of course, decrease the number of jobs, which means the unemployment rate will rise. And the unemployment rate in Argentina increased almost to 20%. One of the biggest unemployment rate at that time. And the inflation, the prices of goods and services also increased rapidly to 20%. Why would the inflation increase? Why would the prices increase, by the way? I hope you have understood that why the unemployment rises, because of less production, right? Because of
Yes.
less production, the producer will hire less people and the unemployment will rise. But why will the inflation increase? The prices will increase. Now, when the production is less, the supply of goods and services is less in the market, right? Supply is less now when the production is less, right?
Yes.
And when the supply is less, don't you think that the price will rise? When there are only few goods which are supplied to the market, what will happen to their price?
The price will increase and the demand for that also will increase.
Demand, let's say that demand is constant, like we all need to eat, let's say, bread. And
Okay.
there were 10 companies producing bread. Now only one company is producing bread. We all will go and buy it. What will happen to the price of bread?
It will increase because
It
of
will increase.
scarcity.
Yeah, because of the scarcity. The moment production falls, it has a very strong impact on an economy. It will make unemployment rate to go up, mean the people will lose jobs. When they have no jobs, they cannot have good living. You know, without a job, can you afford good living, good food, good health? You cannot do that. So the quality of living goes down when the unemployment rate is very high. Similarly, when the because when the production is less, people have less jobs, but at the same time, because of less production, the prices become very expensive. So now you can see that how strong this impact could be. On one hand, people don't have jobs. On other hand, the prices of goods and services are very high. So now you can imagine that how would the people manage in this country? In such a country where you don't have a job, but the goods and services that you need to buy, the basic needs that you need to buy and fulfill are very expensive. Do you think you would be able to survive in such an economy? So that is why it is very important for the government to take the right decisions. They need to look into the long-term effect. In the short run, the Argentina enjoyed. What happened in the short run? Here. The inflation went down and the investment came in, right? But in the long run, what happened in 2002 almost? After how many years? They took this decision in 1991, correct? So almost after 10 years, what have they seen? They have seen that now the imports are falling and because of which the unemployment rate is rising and the prices are going up. So okay, these are the three factors that can relate and that should be, paid due attention by the government whenever they are looking into the currency. They need to develop a proper fiscal policy. They must have a labor market inflexibility and they can look at the contagion from the financial crisis in Brazil. Yeah, they are talking about the Argentina. See, there are at least three factors that are related to the collapse of currency board arrangement and the ensuing economic crisis. What are those? The financial discipline. And I told you last time what is, sorry, the fiscal discipline. What is fiscal? The management of tax. Okay, that's called fiscal. Then labor market inflexibility. Labor market was not flexible because of course you have limited labors available in a country. Then at the same time, when the crisis happened in Argentina, a crisis was going on in the neighboring country. It was happening in Brazil as well as a crisis was going on in Russia. So this crisis is a contagion. Contagion, it means parallel effect. This has a parallel effect on the government of Argentina or the economy of Argentina as well. So then we have few lessons. Okay. Lessons we already know. What are the lessons? That the government should not think short term. Government should have a proper fiscal policy. It's not easy just to attach your currency with any stable currency and just sit and enjoy. No, it can have a negative effect like what Argentina had on its economy. So we have taken these types of exchange rate, fixed exchange rate versus flexible exchange rate. Fixed exchange rate where the government fix, okay, $1 is equal to 1 dirham or 2 dirham is equal to $1. They fix it. So it has its own advantage and disadvantage. In the flexible, as I told you, the flexible exchange rate depends upon the demand of the dollar and supply of dollar. and demand of the dollar depends upon the imports and supply of dollar depends upon the export. So which means flexible exchange rate system depends upon the import and exports of the country. So arguments in favor of flexible exchange rate, easier external adjustment mean automatically adjust according to the demand and supply. And national policy autonomy. The policy is autonomous. You know, there is no influence on the policy, exchange rate policy, of course. And exchange rate is determined by the demand and supply of the dollar, which mean import and exports of the good, which is a real exchange rate. Okay, that's fine. But arguments against the flexible exchange rate are exchange rate uncertainty may hamper the international trade. As we have said, if the exchange rate keep on changing every day, do you feel comfortable in investing in that country? Will you go and trade with that country where the exchange rate is fluctuating and changing every day? Of course, the answer is no. In our last session, we also discussed that one of the very important factor where the multinational corporation before investing in a country look at is the stability of exchange rate. So with a flexible exchange rate, it keeps on changing every day and no safeguard to prevent the crisis. Crisis can happen at any time. Why the crisis is more prone to flexible exchange rate? Why we feel that flexible exchange rate can result in crisis at any time? Why? Do you have any argument for this? He says that no safeguard to prevent the crisis. Mean price crisis can happen at any time in case of flexible exchange rate. And what is flexible exchange rate? Where the exchange rate depends upon the demand and supply of dollar, which means demand for the dollar depends upon import and supply of dollar depends upon export. So I can say that flexible exchange rate depends upon the import and export. But how can we say that it does not prevent the crisis?
Because the currency keep change, like
It will
at
change
any
with
time.
respect to what?
At any time can go up or can go down.
But what will make it go up and down? That is the concern. In flexible exchange rate, what makes the currency to go up and down?
The dollar
The
value.
dollar. But what of dollar? The supply of dollar and the demand for dollar, right?
Right. The supply and demand, it depends on the supply and demand of the dollar, which
And the
is
supply and demand depends upon what? Demand depends upon what?
demand on the
Demand of the dollar depends upon what?
The
Import or
exports.
Demand for the dollar depends upon the import. Like I am in UAE, I am buying a car from US. So what do I need to make a payment to the US exporter?
Dollars.
Dollars. So don't you think I will go and buy the dollar from the market, from a bank, from any exchange? I will have to buy the dollar. So I will not demand the dollar at this moment because I need dollar to make a payment, right? So demand for the dollar depends upon what?
The import.
Demand depends upon imports, right? Whereas supply, how will the more dollar come into the country? When you will export, no? When you will export the goods. Like UAE selling dates and oil. What are they getting in return by selling it?
Dollar.
So the dollar, more dollar comes in, means the supply of dollar rises. And demand for the dollar, whenever you buy the goods, which is called import from other country, you need dollar to pay them. So demand for the dollar rises. So in flexible exchange rate depends upon what? Depends upon supply and demand, correct? The flexible exchange rate depends upon the supply and demand of dollar. Fine. So the demand and supply depends upon what? Demand and supply depends upon what? Import and
Export.
I hope you are following me, right?
Yes.
So now the question is, yes. So now the question is, can you always control your import and export? Have you ever seen any country with a rise in export forever and fall in import forever?
No.
So it means you cannot control the import and export. Fine.
Correct.
When you cannot control the import and export, can you control the demand and supply?
No.
So when you cannot control the demand and supply, can you control the floating exchange rate system?
No.
No.
When you cannot control it, can you prevent any crisis? Can you control the crisis?
No.
That is why in floating exchange rate system or flexible means floating, okay? Flexible or floating exchange rate system, the crisis cannot be prevented. If, like, for example, 80% of your exports, like, for example, 80% of your exports are with which country? For example, Africa. You are selling 80% of your exports to Africa. Now the African countries did their own research and development and they start producing their own goods which you are selling them because your goods are expensive. What will you do? This 80% will come down to maybe 40%, right? When this will decrease, what will happen? Your export will decrease. When your export will decrease, your supply of dollar will fall, right? And what will happen to your exchange rate? And what will happen then? Because your export will fall. When your export fall, do you think the producer will produce goods or not? Production will fall. When production will fall, what will happen to the unemployment? Unemployment will
Increase.
increase. And what will happen to the inflation? When there is no production,
Increase.
inflation will also
Increase.
So what will happen to the entire economy? What is the common term we use in this situation? When the people don't have jobs, mean unemployment is there. When the exports have come down, inflation, mean the prices of goods are too high that they are not affordable for the people of the country. This is called crisis.
Economical crisis, yeah.
So this is how the flexible exchange rate system can result in a crisis and it is out of the hand of the government. Do you think the government can control it? You cannot control the exports all the time, right? And when you cannot control the export, you cannot control the supply. When you cannot control the supply, you cannot control the employment, you cannot control the inflation. So this is the job of, yes, please.
Okay. When the government devalues the currency, the demand increases because of the rate
Sorry,
of
please, let me follow you. You said when the government devalue or depreciate the currency.
Yes, the demand increases, right?
The demand of what?
Of the goods.
See, when the government devalue the currency, now talk about the import and exports.
Yes.
The export will increase and the import will decrease, right?
Yes.
finance هو business.
Okay.
business فيها مواد finance.
Now please go ahead.
اسألها هيدا هو.
Okay. So the demand for the product, it will increase because they can buy that country goods with the less amount of money, right? So what will happen with the supply?
You are slightly lagging, please. If you can repeat this last part of your question.
Okay. When the government devalues the currency, or when it's decreasing the currency, the demand of the goods will be like increase, right? Because
demand will decrease.
Yeah. The demand will increase. What will happen with the supply?
Yeah, the supply is expected to increase.
من اللابتوب هلا. لا اللابتوب مش
Why?
Hemen?
Why the supply increases?
Okay, yeah, I'm coming to you. I got your question.
ما عطوا اكونت عطيتهم اكونت لإله عاد من الجامعة.
Hemanat?
Yes, I'm here.
Yeah, please. if you can mute your mic.
Write your name.
Okay. Now your question is, I think this is guest who asked me the question, right? You said that when the currency, the government devalue the currency, the exports are expected to increase and the import are expected to decrease. And she said, why will the supply of dollar will increase? As I said earlier, when the government depreciate their currency against the dollar, the products of this particular country become cheaper in the international market. Because now the international investor who is buying the goods from your country, because your currency is cheap, so he can buy more good with $1. So he would like to buy more. So the demand of your goods in the international market, which is called your export, will increase. So they will buy more and now they will give you more. In return, you will get more dollar. So when they will buy goods from your country, which is called export, so your export will rise, more dollar will come into the country, which is called supply of dollar. So the supply of dollar will rise. And at the same time, because of this devaluation, for the importer of your country, the goods from the other country, if they buy the goods from other country, they become more expensive. So they will try to buy less because now the goods from other country, which are called imports, become expensive for them. So they will demand less goods and the import will fall, which means the demand for the dollar will decrease and the supply of dollar will rise. This is what it happens in the depreciation of currency, right?
Yes, but what
Any other
about
question?
the good producers? Like, do they increase producing it more?
See, of course, when the export rises and you feel more demand by the international people for your product, you will increase your production. And when you will increase your production, you will hire more people, right?
Yes.
So what will happen? The more people will get jobs, more production will happen and you will export more and more dollar will come to the country.
So now we can say the demand will increase, the supply also increase at the same time.
The demand of the dollar?
No, the product.
Yeah, of course, the demand for the product will increase in the international market. So you will produce more and you will sell more.
Yeah,
And in
so
the process of doing so, you will get more dollar from the international market and you will bring into your country.
Okay. Thank you.
Right?
Yes. Thank you.
So now we have another very important chapter which an international financial manager will have to look at very closely. That is called balance of payment. Now this balance of payment is one of the very important phenomena that the multinational corporation should look at. What is balance of payment? Balance of payment is simply a record of one country transaction with the rest of the world. I mean, whatever the country, whatever type of business or non-business activities a country does with any other country in the world, it is maintained in an account which is called balance of payment account. Like from some country, they buy the goods and services. In some country, they sell the goods and services. So all the record, and also they also invest in some stocks and bonds in other countries. And the investors of other countries come and buy the shares and bonds in your country. So all these transactions are maintained in an account which is called balance of payment. A balance of payment is a comprehensive record which shows all the transactions of the country with the rest of the world. Transactions for goods as well as services, plus transactions related to bonds, stocks, into the foreign exchange markets, all the transactions which are related to any particular country, they are maintained in their balance of payment account. Now, balance of payment account has been further divided into four type of accounts. One of them is called current account. Now these are the components of balance of payment. Within balance of payment account, you will find these four accounts: current account, capital account, official reserve account, and statistical discrepancy account. So now we will discuss each one of them individually. There, what are these accounts and what is their significance? So the first one is the current account. We have already discussed about two very important part of international business. What are those? They are the import and exports of what? Of goods and services. So the record of import and export of the goods and services is maintained in an account by the country. They import the goods and services from a country, they export the goods and services to many other countries. So the record of both import and export of goods and services, remember, not anything else, only goods and services. This record is maintained in an account which is called the current account. And sometime the import are more than export, and some we have two terms, trade deficit. Sometimes this account shows a deficit, sometimes this account shows a surplus. What is deficit? When the exports, or you can say imports, are more.
We cannot see your slide.
Oh. Let me share again then. Can you see now?
Yeah, thank you.
Yes.
Okay, so I think you also did not see the previous slide yet, right? This is the balance of payment. So the balance of payment we said as four component. What is balance of payment? Balance of payment shows the record of all the transactions between the country and any other country, or you can say the rest of the world. This account has four components: current account, capital account, official reserve account, and statistical discrepancy. And I said, now we will discuss each one of these four different type of accounts, which together create the balance of payment account. Collectively, they all are known as balance of payment. So the first one is current account. Current account basically shows all the record of import and export. Imports and export. Of what? Of goods and services only. So the record of import and exports of the goods and services are maintained in an account which is called current account. Now this current account can show us two type of balance. A balance can be in the form of deficit, or a balance can be in the form of surplus. So what is deficit? Technically it is known as trade deficit. Some people also call current account as a trade account because it shows the record of trading for goods and services, because you are trading goods and services with other countries. So that is why it is also known as trade account. So this current account can have, or trade account can have, a positive balance, which is called trade surplus. And it can have a negative balance, which is called trade deficit. Now trade surplus happens when the, like, if you compare between import and export of a country, what do you think? For a country, is it good to have more export than import, or more import than export? Which one of these two is ideal for a country? Having more export and less import, or having more import and less export?
More export.
More export and less import. This is what every country is trying to achieve. They are trying to increase their export and decrease the import, because this will have a positive impact on their currency, then on economy, then on jobs, inflation, production. So this is called trade surplus. Trade surplus happens when in this account your exports are more than your imports, right? When the exports are more than imports. When you are exporting more and importing less, let's say your export was 2 trillion or 5 trillion and your import is 2 trillion. So what is the difference? 3 trillion. This 3 trillion is your surplus. But this can be otherwise. You might have a deficit. And when the deficit will happen, in case of deficit, imports are more than export. Like you are importing, let's say you imported goods of $7 trillion, but you exported $4 trillion or $5 trillion. So how much is your deficit here? 2 trillion is your deficit. So the current account sometimes shows the surplus, sometimes shows the deficit, and that is the primary objective of the government, to create a surplus in the current account, which means the export of the country should be more than the import, because this will have a very positive impact. How? Can anyone tell me if there is a trade deficit, sorry, trade surplus, how this trade surplus creates a very strong positive impact on the entire economy? How?
More
It
jobs.
will affect the economy.
There would be more jobs.
Okay, good. That is the first effect. Mean exports are more than. This is the surplus. Now tell me. So he said that this surplus will create more jobs. Tell me how. How it will create more jobs?
Because there's going to be more production required.
Very good. Because you're exporting more, so you need to produce more. Only then you can export. So for producing, you need workers, laborers. You will hire more people and more people will get job. So which means employment. Can I say employment will rise, right?
Correct.
Now, what other effect it will have? Any other positive effect?
Standard of living will increase.
Very good. Living standard will increase. And how? How? Tell me the channel.
Due to employment, people are able to have a proper income and they have a stability, and they're able to spend more on their requirements.
Exactly. When they have employment, they have jobs, they can afford better living, better food, better school, better education, better health. So the living standard will improve. What else? When you are producing more, of course, you will be able to supply more in your own country, right?
Investment
Right.
will increase.
Investment will increase. Very good. Like what has happened in China? Don't you think investment has gone up in China?
Yes.
Why? Because the China export is more than the import. So investment will increase. Very good. So any other impact, any other positive impact? What will happen to the inflation?
Inflation will come down.
Will come down or it will remain stable? It will not rise.
It will not rise.
Either it will be stable or it will come
Stable,
down.
or it will come
Because
down.
now if you take the example of China, the China market is flooded with their own local products because every company is producing the goods there, right? So the price, of course, when you are producing in China, don't you think China is also one of the biggest market for you? Will you produce there and take it to rest of the world? Of course you will, but you will also target one of the biggest market in the world, right?
Correct.
So this also, when the exports are more, it encourages the local producer to produce more. And when they produce more, of course, they send it to rest of the world in the form of export, but at the same time, they also send it to the local market. So it keeps the prices in the local market stable. So the inflation is under control. This is another very positive impact of exports. That is why in the last 5 years, the US during the Trump regime was in debate and regular discussion with China. Why? They were fighting over this trade. This trade, the China was having trade surplus with the US, but the US was having trade deficit with the China. You got my point?
Yep.
The US was having trade deficit, but the China was having trade surplus with US. And how did that happen? Because China was exporting more to US and importing less from US, right? And the US was importing more from China and exporting less to China. And in return, what was happening in US? Because of this trade deficit, what was happening in US? Let me open a slide here. I mean, why the US government was so concerned? And they were right so, because what was happening here? Now, in case of China, China was having trade surplus or deficit with US?
Surplus.
They were having surplus. And in US in return was having
Trade deficit.
trade deficit. Now, this was the major bone of contention, because US knew this trade deficit was eating up what? What was happening because of this trade surplus in US, trade deficit in US? In US, unemployment was on rise, right? Why? Because they were buying all the goods from China and no production was happening in US. So unemployment was on rise, correct? Then, because of less production within the country, the inflation was rising. Then, less investment, fine. And because of less unemployment, what happened? The living style of the people was going down. Living standard was going down. Right? That is why the US was concerned. They said, we are having trade deficit with you. We want to overcome this deficit. You are having a trade surplus. You are enjoying everything. You have less unemployment. You have less inflation. You have more investment. And the standard of living in the China is rising every day. But we are not having this. So let's sit on the table and resolve this issue. So the point is, this is how it is important for an economy and for the businesses as well. Now, would you like to go to a country where the standard of living is very poor? Like, for example, you are an international finance manager. Your company asks you, we want to invest $1 billion in any country. Tell us which country you want us to go. So don't you think that the living standard will affect the demand of your goods in that country? Like, for example, you are selling Ferrari. Would you like to go to a country in Africa where the people don't have basic food to eat?
No.
So the living style does affect your investment. This is where you will have to decide as a finance manager. You need to look into these aspects because you are doing an international financial management. You need to see what are the government policy, where the trade deficit is happening. That is the reason you are taking these chapters in this course. That you need to go into the international perspective of everything because your investment is at stake. You need to see, is this government has a deficit? If the government has a deficit, it means there is more unemployment. People don't have jobs. They don't have income. When they don't have income, will they be able to buy your goods and services? That's a big question for you to decide. What is the living style? You need to study the living style. Can the people afford the goods and services that I am intending to sell? Or will they do so? These are the questions you should ask yourself as an international finance manager. That is why you need to understand these concepts. And similarly, if the country has a trade surplus over the last 3-4 years, you will study the trade surplus of the country, which means their exports are more than import, which means that there is less unemployment, more employment. Inflation is controlled. Employment is high. People have more income. Their living style is good. Okay, now think, do you think my product can be sold or the people will be interested in my product? Then decide. This is how these concepts are very important for the international finance manager to understand. So any question before we move on to the next part of balance of? Now these are 4 accounts which we are taking in this chapter together create one account which is called balance of payment. This balance of payment is one comprehensive book which is maintained by a country which shows the record of its transaction with the rest of the world. The first account in this book is called current account. It is also known as trade account. And it shows the record of exports and imports of a country with the rest of the world. And it can show 2 types of balance, either a trade deficit or a trade surplus. Trade deficit happens when the exports are less than the imports or imports are more than the export. It is called trade deficit. And trade surplus happens when the exports are more than the imports of the country. So any question from this first part? Yes, Sheldon, your mic is muted if you have any question to ask.
No, no, thank you.
Okay. Anybody else? Ramona, Sophia? I hope you guys are there.
No, Dr. Khan, I'm good. Thank you.
Dr. Faisal, I have one question.
Yes, please.
For an example for China, which has more export and specific to towards US, doesn't that exchange rate also affect the country appreciates or depreciates exchange rate? Because even now, dollar is more comparatively to China, whereas the investment to China is more than US.
Yeah, very good question. Very good question. He said that if you look at the Chinese currency and compare it with the US dollar, their currency is still weak as compared to US dollar, but their exports are more than US. How come? And the answer is very strange, but very simple. China don't deal in their own currency when they are doing international trade. This is also one of the bone of contention between China and many other countries like US, Russia, France, Germany. China don't deal with you in terms of their local currency. They only deal with you in terms of dollar. This is how they are protecting themselves. I hope you got my point. That when they are involved in exports and when they are involved in import, they are only concerned about the dollar. Number one. Number two, because China is one of the richest country in the world, richest in terms of cash, right? So they have the highest amount of foreign exchange reserve with them. And I hope you know what is foreign exchange reserve. Foreign exchange reserve means the amount of dollar that you have with yourself. So they have a huge amount of cash foreign exchange reserve, which no country in the world does have. So because of that, they are able to maintain themselves. And when they are dealing with any international business, whenever there is exports or imports, they don't deal with their local currency. They only deal with dollar. This is what they have been doing. They are not exposing their local currency to the international market. You got my point? Now you see
Yes.
that their local currency is weak as compared to dollar because the local currency can become strengthened only when it is brought to the international market. You got my point? Like, for example, you are selling a car and I am selling a car. My car is in the international market and everybody can determine the worth and the value of my car. But you never brought your car to the market. Until and unless your car is not in the market, how will you determine the value of your car? So the China is not bringing their local currency into the market. They're not trading in it. And now your question might be, you can ask me another question, then why other countries don't follow it? My question is, you need a huge amount of dollar with yourself because you are not the dollar producer. You cannot print dollar. Dollar belongs to the US. So do you think any other country has enough dollar with them to deal with dollar at international level? If you have, okay, fine, go ahead with the dollar. And you will have to maintain it. But if you don't have enough dollar in your banks, I mean, with the government, How will you deal with the dollar internationally with everyone? Then in that case, you will have to discuss with them about your currency, right?
Yes.
I hope you got the point. Your question is very valid. That export of the China are more than the export of the US, then how the Chinese currency is weak than the dollar? Because the China don't bring their currency to the international market. They don't want to compare it with the dollar. They don't want to determine the exchange rate. And in return, they're dealing with dollar. And the reason is they are able to do so, they have a huge amount of cash reserves of the dollar with them. That is why they can do this. And other countries are not able to do this. Like those countries which are underdeveloped. I hope I answered your question.
Yes, thank you.
Just a minute. Can we take just a very little and quick break of 10 minutes only? It's,
Okay.
it's 10:27 with me, and I will exactly be back at 10:37, right?
Okay, sir.
Okay, thank you very much. Okay, so let's begin now. Third. Can you see the slides?
Yes, doctor.
Okay.
Yes, yes.
So then the next one is capital account. Capital account shows the record of these three type of investment. Foreign direct investment. Anybody knows what is a foreign direct investment? It shows the record of FDI, foreign direct investment, and FPI, foreign portfolio investment. FDI and FPI. What is this? Can anyone tell me what is foreign direct investment and foreign portfolio investment? Do you have any idea? Foreign direct investment is the investment in the real production of goods and services. When any foreigner invests in your country and he is investing in a manufacturing plant where he is going to produce goods and services, that is called foreign direct investment. And foreign portfolio investment, when the foreigners are investing in the portfolio. What is portfolio? They are your stocks and bonds. Like any foreigner invest in Abu Dhabi stock market, they buy shares from there, or Dubai financial market. They buy shares or bonds from these markets. That is called foreign portfolio investment. And foreign direct investment, when any foreigner like McDonald open a new outlet here. So that is also a foreign direct investment. Adidas open a manufacturing plant. That's a foreign direct investment. It's not a foreign portfolio investment. If any foreigner invests in the stocks and bonds of the country, they buy the shares of the bonds from the bond market and shares from the stock market. That is called foreign portfolio investment. So record of foreign direct investment and foreign portfolio investment is maintained in an account which is called capital account. Then the third is the statistical discrepancy. Yeah, statistical discrepancy basically means that whenever there are some differences, it's not always possible that you will have an exact accurate record of your balance of trade, which is called current account, and the capital account. Sometimes some discrepancies always happens. You don't have some information, so you cannot have an exact balance in the current account as well as in the capital account. So these discrepancies or differences are maintained in a separate account, which is called statistical discrepancy account. That when, it's not always possible for every government to keep the record of each and every import and export. Some of them might go missing. You don't have the record for some of them. And that creates an imbalance in your current account and capital account. So these records are maintained in a separate register, which is called statistical discrepancy. Then we have official reserve account. Means every government has some other reserves like gold, foreign currencies, and SDR, special depository receipts, and some other reserves with IMF, International Monetary Fund. They are also very important part of the balance of payment. So these golds and foreign currencies like dollar, euro, or pound, if the government has, they are also maintained in this account. The gold is maintained in this account, and the special depository receipts and any other receipts from the International Monetary Fund are maintained in this account, which is called official reserve account. So we have these four types of accounts within the balance of payment. So the balance of payment consists of current account, which is also known as trade account. It consists of capital account. It consists of official reserves, and it consists of statistical discrepancy. Once again, what is the current account? Current account is also known as trade account. It shows the record of import and export. There can be a trade deficit or trade surplus in this account. Trade deficit happens when the imports are more than exports, and trade surplus happens when the exports are more than imports. Second account is called capital account. Capital account shows the record of all the foreign direct investment and foreign portfolio investment by a country during a particular period. Foreign direct investment is the investment of the foreigners in a real output of the goods and services, production of goods and services. Whereas foreign portfolio investment is the investment in the stock market or the bond market of a country. So the record of these foreign direct investment and foreign portfolio investment are maintained in an account which is called capital account. The third one is official reserve account. In this account, the record of all the golds and the foreign currency and special depository receipts and any other receipts from IMF are maintained in this account. And the fourth one is not basically account. This account is created because of the discrepancies in all the accounts. Sometimes you have a discrepancy in official reserve, in current account or capital account. All those differences are maintained in that account, which is called statistical discrepancy account. So this is all about the balance of payment. Then the next and a very important chapter for us is the corporate governance. Do you have any idea what is a corporate governance? Have you ever heard about the corporate governance? Or what do you think? What is a corporate governance? Anyone? Do you have any idea what is corporate governance? What is governance? What is governance? That's a very common word that we apply even in a country. The governance is not good in this country, or governance is good in this country. What is governance? Okay. Have you ever seen the organizational structure of any company, corporation? Have you ever seen the organizational structure of a company?
Yes.
The decision makers, the governance.
Yeah, the decision makers, exactly. Just give me a moment, please. Okay, so let's come back to the point. So governance, yes, this is about the management. When we talk about a company, have you ever seen the structure of a company? And have you ever seen, you might be working in a company. So what is the structure of your company? Who is the owner of the company? Shareholders, right? Asset shareholders, they are the owners of the company, fine. Then these shareholders, what do they do? Do you think shareholders do the business by themselves? They manage all the matters of the business by themselves. Do you think so?
Board of directors.
Yeah, they appoint the board of directors, which is commonly known as BOD, board of directors. These are the people who are appointed by the shareholders, owners of the business. They are owners. And this is the BOD who are appointed by the shareholders. Now, these board of directors, what do? They appoint a CEO, right? And then the CEO appoint various departmental heads. This is called organization structure, right? Like it depends upon our GM finance, Then they have a GM HR, different departments. Then they have a GM marketing. Then GM production. Then there is a GM, let's say supply chain. And so on. There can be nowadays a GM IT. So then what happens next? What do they do? Each of the like GM finance will run his department, and in his department, he will appoint manager finance, assistant manager finance, right? So this structure then continues, right? This is called organization structure. And this is the type of structure that is what we can see in most of the corporations around ourselves. Now here, who is managing the business? Who are the decision makers? Tell me.
The board
Who
of
are the main
directors.
decision makers? Board of directors have given the power to the CEO, right?
CEO, yes.
Shareholders are not the decision makers. They are not involved in the business matters. They have given their power to board of directors. Board of directors have given their power to CEO. Now the relationship between these three parties is very critical. That is going to determine the success or failure of the business. This relationship is known as corporate governance. Simple as that. Corporate governance. The relationship between these three parties. Who are those? Owners, board of directors, and the who is the management? CEO is the management. So the relationship, the study of relationship between the shareholders, board of directors, and the management, mean the CEO of the company, is called corporate governance because they are going to govern the business. They are going to directly or indirectly take the decision. So this is what we are going to look at in this chapter, that how this issue, because there are a lot of problems in their relationship which basically affect the international financial management. So when a company is involved in international finance, how they should maintain the relationship between the shareholders, the board of directors, and the CEO, so that which basically benefit the company itself. So the relationship of these three parties called corporate governance, which we are going to discuss in this chapter. Okay. Now, what are the issues in corporate governance that we shall try to address in this chapter? One of the issue is the conflict of interest between the manager and the shareholder. Who is the manager here? In this diagram, who is the manager? CEO is the manager, right? CEO is the manager. And who is the owner of the business? They are the. Do you think that there can be a conflict between the owner and the manager? Conflict of interest. Do you think this can happen? Or has it happened? This is the first problem. What is the interest of the owners here? What is the interest of the shareholders, by the way? What is their interest in the business?
Profits.
Profits, yeah.
If you recall our chapter number 1,
Increase of wealth.
that what is the goal of a business organization? What is the goal of a company? To maximize the profit or maximize the value of their share? If you recall the first session, we discussed it in detail.
Value of the share.
Value of the share. Of course, profit is one of the part which you will have to achieve, only then the value of share will go up, of course, but it is not the only factor. Fine. The goal of the company is to maximize the value of the share. To achieve that goal, of course, you will have to make profit. You will have to take care of your social responsibility. You will have to take care of your environment. You will have to take care of your internal and external stakeholders, right? Profit is not the only factor which is going to give you the maximum share value. Do you agree with it? Do you agree that profit is not the only factor which is going to give you the maximum shareholder value?
Yeah, definitely, because the other factors, if it doesn't fall in line, then that will affect the share value, and then it will, even though you gain profit, if the others doesn't be in line, then it will decrease the value of your share in the market.
It will, I mean, reputation, your reputation does matter. Your corporate social responsibility is one of the key factors. Environmental responsibility is one of the key factors. Nowadays, if you look at the menu of McDonald's, have you observed some significant changes in the last few years in their menu? And what are those changes?
Yes, they display their the values of, I mean, the nutritional value of the menu, what they give. And then there is more of a salads and, like, you know, healthy options incorporated.
You know, the healthy products are on rise, and they have realized that obesity is one of the major issues that people are, you know, suffering all over the world nowadays. So how long they will keep on selling the food which create obesity? So they are now adding more healthy products to their menu. You might have witnessed this, right? Then at the same time, if you have visited the McDonald's outlet here in UAE or anywhere, you might have seen that they are offering some place for the kids to play, and they are offering free Wi-Fi as well. Okay. Now, why are they doing so? It is a part of their social responsibility. It is a part of CSR, corporate social responsibility. So these are the little steps that the corporations will have to take, other than the profit, to increase the value of their share in the market. Reputation does matter, and these steps create reputation. So now the goal of the interest of the owners who are shareholder is to increase the value of the share, right? But what is the interest of the management? If you look at the screen, who is the management among these three? Shareholder, board of director, and the CEO. Who is the management?
CEO.
What is his interest? What is his basic interest in the business? What do you think? What is, if you are a CEO, what is your basic interest of sitting in that office? Your personal basic interest, I'm asking you.
Career. Profit.
Profit. So you will not be concerned about your salary?
I'm telling you, the career itself.
Yeah, the career, which includes what? If we break down the career, your salary, right?
Salary, work.
Other benefits other than the salary. Job security.
Stability.
Stability and the power of the job as a CEO. You don't want to have the power as a CEO? So these are your personal interests. So now what happens actually, which has happened in many cases, I'll give you some examples as well, that the interest of the management, who is the CEO, conflict with the interest of the shareholders, owners. And so far we have established that the interest of the shareholder is to maximize the value of their share, which is called business growth, right? But the interest of the CEO sometime, you know, is to protect his own personal gains, which include his salary, his power, his extra benefits, his promotions, and all those things that personally attracts him. This conflict creates the problem for the business, which is called agency problem. Because management is acting as an agent of the shareholder. Management is acting as an agent of the shareholder. So this conflict of interest between the management and the shareholder damage the business. And in this chapter, we will learn how to minimize this conflict. Like, for example, you are a CEO of the company and I am the shareholder. I am interested in investing $2 million in my business. And I asked you, please do a feasibility study and let me know we want to go and invest in Abu Dhabi. Currently, not in Dubai. We are distributing to all the Emirates around Dubai. But now we want to go and open another manufacturing plant in Abu Dhabi. And I asked you, please do a feasibility study and let me know in period of 1 month. I'm interested in investing $2 million. You are an expert, you are a CEO, you did analysis and you hired the consultant. And after all the feasibility study, you came up with a conclusion that yes, Dubai, Abu Dhabi is one of the very good market for this type of business. We should open a manufacturing plant there and it will help our business to grow. And it will help the share or the market value of the business as well. This was the conclusion of the report that you came up with. And tomorrow morning, you were supposed to present it to the shareholders. But before presenting it to the shareholder, somebody told you that the shareholders are planning to appoint a new CEO for the manufacturing plant in Abu Dhabi. Now, what would be your interest during the presentation? What would be your reaction to this? How it will affect your decision of recommending or not recommending to open a plant in Abu Dhabi? Tell me now, as a CEO. Reports are there with you. You are going to present it to the shareholders in an hour. You have been told with this. So now look into your personal interest and let me know. Will your personal interest affect your decision now here? Because shareholder will depend on your decision. So what would you do in this case? Keeping in mind that you have your own personal interests. What was your personal interest, by the way? In case of this new plant in Abu Dhabi, what could be your interest? Tell me. Anyone, please.
Take control of the new plant as a new CEO.
Very good, yeah. Increase in power, control of that plant, right? Maybe another office in Abu Dhabi, more employees, or at the same time expecting a raise in the salary because you are now managing 2 plants, right?
Eliminating competition.
Yes, Hamid?
Eliminating competition. I don't want another CEO.
Very good. Do you want any other CEO? No, of course not. He would become your competitor. And then the shareholder will measure your performance with his performance, right?
Yes.
So now keeping these interests in your mind, you have been told this information that the shareholder are planning to appoint another person in that factory if they are going to open that manufacturing plant in Abu Dhabi, if they are going to take this decision. Now, what would you do when you will walk in and present them the report? Don't you think it will affect your decision of advising them to invest or not to invest? I'm asking you, please, if anybody can just give me his views.
The suggestion will be not to invest.
And why would that be the suggestion?
Because it's a last moment, and if the report is there and the presentation is, it's all in favor of opening a new plant. If that happens and if the shareholder agrees, that means they will definitely appoint a new CEO, which will be a direct competition to him.
Correct.
So either
which
he has a
means when I
choice
say
to.
that Yeah. So which mean, can I say that your personal interest is prevailing the interest of the corporation at the moment?
Yes.
This is
My
called
survival
conflict.
depends on it.
This is called conflict of interest. Now your interest is conflicting with the interest of the business. What is the interest of the business? If you ignore your interest and you are talking about the interest of the business, what should you do when you walk in? You should advise them because the report is there with you. If you are thinking about the interest of the company, you should advise them, okay, go and open the factory there. But if you are taking care of your own interest, you will advise them otherwise, which is against the interest of the company, right? This is called conflict of interest. When this happens, now you can imagine that how the businesses would suffer. And there are many examples I can tell you. There are many examples where this has happened. For example, how many of you are aware of the issue of NMC in the last year that happened in UAE? Are you aware of the NMC issue?
Yes, the management issue, yes.
It was one of the management failure where the CEO of the NMC took huge amount of loans without looking into the impact of loan on the business, because those loans were helping him to protect his personal interest. But he did not look into the impact of those loans on the balance sheet. You know, if a company is loaded with a loan in the balance sheet, how would you assume about such a company when you will look at its balance sheet? Is it risky or not risky?
Risky.
And how will you deal with such a risky company? You will have more strong terms and conditions as a supplier, as a shareholder, as a financial provider. You will have strong terms and conditions, or you will avoid dealing with such a company. This is what it happened with NMC. And the CEO was interested in his personal gains for short-term gains, where he was taking loan and investing without looking into the consequences that when these loans will become due, will I have enough cash to pay back? Will I have enough profit to pay the interest? Now, these are some of the corporate decisions. This is called conflict of interest. This is where the shareholder will have to be careful, because see, if I am the CEO, I am a human being. Do you think I can always be, I will always be able to control my self-interest? Can we do this as a human being all the time, always? As a CEO, can we do this? Naturally, it seems impossible unless there is a strong system which is going to force me to take the decisions in the interest of the company rather than my personal interest. And that system is what we are going to study in this chapter. This chapter is going to tell us that how can we minimize the conflict of interest between the shareholders and the owners of the business, which is very important. I have a case as well, which I will give you at the end of today's lecture, and I will suggest you to read this case before you come to the next session. There are some questions at the end of the case, and we will discuss them right in the beginning of our next session. But you will have to read the case first. So this is the corporate governance, and this is called the first issue of corporate governance. What is it? It is the conflict of interest. I hope now you know the conflict of interest between the manager. Who is the manager? And the shareholders, owners of the business. Then another issue is, this issue happens when the ownership is diffused. Anybody knows the meaning of word diffused? What is the meaning of word diffused? Diffuse means dispersed, spread. Now, anyone can buy the share of any company at any time sitting anywhere in the world. If you want to buy the shares of Facebook, you can buy. But how would you know that who is another shareholder? Do you know each other? So when the owners don't know each other, when they are connected with each other, this is called diffused ownership. Diffused means they are away from each other. They are dispersed from each other. They don't have information. And this is one of the techniques the manager always do, you know. The CEO always want to keep the shareholder diffused because the longer they'll stay away from each other, the weaker they will be to take their decision against the CEO. This is another very important problem. So the CEO, who is going to take decision of selling more shares or not? The management and the board of directors. The CEO and the board of directors will decide whether we should sell more shares or not. And they always want the shareholder to be diffused so that if they get concentrated, if they get connected with each other, they will plan and they will decide accordingly, and they can take decision against the CEO and the board of directors, and they can remove them. So diffused ownership is another problem, and it increases the conflict of interest. When the owners are diffused, the CEO and the board of directors knows that they are diffused, and they cannot, for removing the CEO and the board of directors, you need the majority. At least 51% of the shareholders should be against the CEO, and if they vote against the CEO, then the CEO will be removed. But to get 51% together is a big issue. They are all over the world. So to get to consensus to vote against the CEO is something that they need to do. And when they are diffused, they cannot take collective decision against the CEO and board of directors. So this is another problem. And we will see in this chapter that how this diffusion can be eliminated. Agency problem, I have already told you. The problem of conflict of interest. Management is the agent of shareholder. Why we call it agency? Simply because the CEO, I hope this slide is visible to you. You can see at the slide, right? Is it visible?
Yes, it's visible.
So the CEO is the manager. So the manager and the shareholder owner, because manager is the agent of the shareholder. Who appoints the manager? Of course, the shareholder appoints the CEO. So he is the agent of the shareholder. He acts on the behalf of the shareholder. Whatever he does, the shareholder are responsible for all of his action relevant to the business. So this, since he is the agent of the shareholder, so from where they derive the word agency. So this agency problem is the conflict of interest between the shareholder and the CEO, which we have already discussed. And this should be minimized. Okay, it says that why you need a CEO. Don't hire a CEO. What answer do you have for it? He says then why, if there is an agency problem, if there's a conflict of interest, then why the shareholder hires the manager? So do you have any answer to it?
Not
And the answer is
not all shareholders are necessarily good at managing.
very good.
That's
Not
why.
everybody who has the money is also a good businessman, right?
Yes.
So shareholders have the money. They don't have the expertise in that business. So what they do, they need the services of a manager to help them to run the business. That's why they will have to appoint the CEO. And by the way, for all the public companies, the appointment of the CEO is mandatory. Every board should appoint a CEO. So, okay, but what are now he's explaining the agency problem, which I have already told you. That agency problem can happen because of the means the CEO has a very lavish living style, and because of that he was always concerned about his personal interest. No matter what is the reason, even those CEO who don't have the lavish living style, still they have a lot of personal interest, So, but some people have intention to steal the other's money. So if you are appointing a CEO, the first thing you should look at is that he is not always looking into the stealing of money. They are giving an example like some Russian oil companies are known to sell oil to managers on trading companies at below market price. Okay, these are some of the examples. We will look into this, that how you can overcome this agency problem. By the way, do you have any solution to this problem where you can, at least control the managers to take decisions for their personal interest? Do you have any solution for it, do you think? Do you have any mechanism?
Auditors, like having a body to overlook as to the decision which has been taken in a company, whether it is abiding the rules and regulation of the company.
Very good. This is one of the way where the shareholder keep a regular check on the CEO management. And the role of the auditor is external auditor who is appointed to do the audit of the management. That is called management audit. He looks into all the policies and decision of the CEO and give a report to the shareholder and tells them in the report that whether those decisions are in favor of the company or against company. In other words, in that report, he determines the conflict of interest or the agency problem. And he give a regular report to the shareholder. This is one of the way the shareholder can overcome or can reduce this problem of conflict of interest. Any other possible way? Of course, this audit is always there. But you know what most of the company have been doing? They are not giving fixed salary to their CEO. What are they giving? They are giving them shares. Instead of salary, they are offering them shares. So what benefit we will have if we offer shares to the CEO? What do you think?
His interest will rely on the gains in the company.
Yeah, because when you will give him the shares, he will become the shareholder. He becomes the owner of the business. So now he will think like an owner of the business and will take decision to protect the business rather than his personal interest. So this is one of the very common method most of the multinational companies are applying. You will not see in most of the companies, like you can take the example of Toyota, Nissan, even McDonald's, KFC. They don't give fixed salary to the CEO. They have given a certain number of shares to their CEO because they know that if we give him a fixed salary, he will just work for his salary and will not focus on the growth of the business. But if we give him shares, then he will be taking the decision to protect the interest of the business rather than his personal interest. He would like to maximize the value of the share that he is holding, which will in return benefit us as well. So that is why most of the companies are now giving shares to their CEO as a form of compensation. Who appoints the CEO? If you go back to this structure, who appoints the CEO?
The board of directors.
You always remember the board of directors appoints the CEO. But the problem happens, and who is there to check all the actions of the CEO? Who keeps a close eye on all the actions of the CEO? Shareholders or the board of directors?
Board of directors.
Board of directors. But the problem happens when one of the member of the board become a CEO. You know, this board has a chairman. You know, board of director has a chairman. And chairman is the head of the board. He has a full power. This board of director appoint the CEO, right? And this board of director, you know, there are at least in different countries, there are different number of board of directors. But let's say there are 5 board of directors and all of them will appoint one head for the board of director who's known as chair. Let's say Mr. A is appointed as a board chair. Now he has a full power to take and look into all the actions of the CEO, right? But what if he also becomes the CEO? Now what will happen? Mr. A is also a CEO and also a chairman of the board of directors. Is he answerable to anyone now? Mr. A is the chairman of the board of directors.
To the shareholders.
He is only answerable to the shareholder. Nobody in the board or nobody from the CEO can ask him any question, right?
Yes.
So this is also another problem. This should be avoided by the company. That a person who is the head of the board should not come and sit as a CEO. If this is happening, he has a full power and he is not answerable to anyone except the shareholder. And shareholder will ask him the question at the end of the year once the damage has been done. During the year, it is the board and the chairman of the board who should question the CEO over his every action. But if the chairman of the board become and sit as CEO, then the problem comes into play. Then he has a full power. He has an ultimate power and he can take any decision that he wants. So this should be avoided by the shareholders. If this is happening, they should avoid it. But sometimes it becomes unavoidable, right? Sometimes he is the most powerful director. He is the only one who has a specialized knowledge and experience in that field. So no one else can sit as a CEO. He's the most suitable CEO. But he said, I will be the CEO only when you make me the chairman of the board, because I don't want anybody to interfere in my matters. So if you appoint me as a chair of the board, only then I will act as a CEO. Now you have no choice. Yes or no. If no, he will leave your company and you cannot run the business because he's the only expert person in this area. So these are some of the situations where you will have to compromise. But the corporate governance rule says that we should avoid a common person, a same individual, sitting as a chair of the board as well as a CEO, because it will increase the conflict of interest. Okay.
In a similar situation, who can fire him?
Similar situation happened where? Please come again.
If he is the only one in power, who can fire him?
If he's the only one in power. Now only the shareholder can fire him, but the shareholder need to get together and vote against him. And 51% of the shareholder vote against him. That is very difficult, you know, because the shareholders are diffused all over the world. It's not easy to get them together. So they can, of course, remove him. But at the same time, if he is the only individual who is most powerful in terms of experience, knowledge, maybe he's also a shareholder. You know what happens sometimes? This board has one of the member who is also a shareholder. I hope you are following me. Shareholders are the owners. One of the shareholder is also supposed to sit in the board, right? One of the shareholders should be there in the board as well. What if he is also the chairman and he is also the CEO? So now who will ask him any question? I hope you are getting my point. So these are some of the problems that are there in a corporate governance. And this especially happens.
Now it's a family business, maybe.
Exactly. This happens. This is what I was coming up to. This happens in a family business. In a family business, the shareholder also come and sit in the board, and he also becomes the chairman of the board, and he also becomes a CEO because he wants to keep ultimate power in his hand. In non-family business, you know, the shareholder does not allow this. They vote against such an action. So board of directors are there. They appoint the CEO. Now the board consists of different numbers in different countries. You know, the structure and the legal charges of corporate board vary from countries. Different countries, you will find different number of board of directors. In some countries, there are 5. In some countries, 7 board of directors should be there. In some countries, there must be a shareholder. One of the board of directors should be a shareholder. Like in Germany, the board is not legally charged with representing the interest of shareholder, but is rather charged with representing the interest of stakeholder. Yeah. In Germany, the role of the board is to take care of the interest of the stakeholders. Stakeholder mean anybody who has a stake with a company, who has a risk with a company. Can be the workers, creditors, suppliers, banks, employees, anybody. Shareholders, of course. Similarly, in some other countries, I think in England, the majority of the public companies voluntarily abide by the code of best practices on corporate governance. It recommends that there should be at least 3 outside directors and the board chair and the CEO should be different individuals. So what happens in England? What is the rule? That the chairman and the CEO should be 2 different individuals. So in England, the chairman cannot become a CEO or a CEO cannot be the chairman. They should be 2 different individuals. And 3 board of directors should be outsiders. I mean, they should be appointed from outside. They should not be the employee of the company. They should not be taking salary. They should not be influenced, because in England, they believe if all the board of directors are the employees of the company, they are taking salary and they will be influenced. So they believe that at least 3 of the board of directors should be the people from outside. They should not be taking any salary and they should just sit and monitor, because they will be independent and they will give you better advices. And at the same time, in England, as per the code of best practices, the chairman and CEO cannot be the same individual. In Japan, most corporate board are insider. You know, in Japan, most of the board of director are insider. You know, insider, who are the employees of the company. He's a board of director, but he's also an employee and he's taking fixed full salary. So in Japan, most of the companies have a board where the board of directors are insiders. And they are concerned about the welfare of the company, of course. Incentive. You can give 2 types of incentive to the board of directors as well as to the management. I mean the CEO. Accounting based. What is accounting based? I mean, given incentive based on, in accounting, what do we calculate? We calculate we calculate profit. So accounting based incentive to the CEO is based on the profit, while another incentive is give him some. What is stock? We have discussed this. Give him some shares. So you can attach his salary with a profit. That if we achieve 30% profit, I will give you a 5% raise in the salary. Or in the next 5 years, if our profit increases by 20%, 30%, 50%, we will increase your salary by this much. So attach the salary with the profit. This is called accounting based scheme or accounting based compensation plan. Whereas stock options, you attach his compensation that if we increase our profit by 50% in the next 5 years, we will give you 10,000 shares of the company. Or if you grow the company by 10% in the next 2 years, we will give you 5,000 shares of the company. This is called stock-based compensation. This is stock options. You can give him stock, but usually what happens that those shares have a maturity of how much? 10 years. I mean, after 10 years, the company usually take back the shares. They give you shares for 10 years. After 10 years, they will take back the share. Of course, against the share, they will pay you the money, cash, not for free. So, and usually they do not take it back before 3 years. OK, so minimum period is 3 years and maximum is 10 years. After 10 years, they take back the shares and pay the cash against the share to the CEO. Now, this is called concentrated ownership. I told you a type of ownership before. What was that? Opposite to concentrated, that was diffuse ownership. What was diffuse ownership? I told you. Can anyone tell me? What is a diffused ownership?
That the shareholders does not meet or know each other.
Yeah, they don't know each other
Spreading.
and they are away. Yes, Ramona?
Spreading the shareholders like many, it's been divided between many.
Yeah, they are not, intact with each other. The shareholders are dispersed, diffused, and they don't know each other, because this is what is in the interest of the management. Because the more and opposite to diffusion is concentration, concentrated when they are together. So, and concentrated shareholders are very good and they keep a close eye on the agency problem and the actions of the management. And the management is more scared from a concentrated shareholder. They know that if we are taking any decision which is against the company and they find out, they will vote against us and they will remove us. So that is why concentrated ownership is much more important in the interest of the company than the diffused ownership. Because concentrated ownership help us to overcome the conflict of interest between the shareholder and the management, and forces the management to take the decision to promote the interest of the business, which is to maximize the value of share. So this is the concentrated, and in different countries, like I said, in United States and United Kingdom, concentrated ownership is relatively rare. You will not find a concentrated ownership over there. Elsewhere in the world, concentrated ownership is norm. Of course, in most of the countries other than the United States and US, you will see a concentrated ownership because owners want to stay closer to each other so that they can know the business and they can take decision together. Yeah, the legal system and the corporate governance is derived from the law of the country. In different countries, different law. Like this corporate governance is protected by English common law, France, it is French civil law, Germany is German civil law, then Scandinavian civil law, which is applied in Scandinavian countries. So these are the laws which protect the corporate governance and forces the company to apply the rules of corporate governance. And the content of the law protect the investors who are the shareholders. Okay. This law, corporate governance, basically the aim of corporate governance is to protect the shareholders. That is one of the most important aim of the business, these corporate governance. Yeah, when these laws are applied, what happens? They protect the investors' right. And of course, if the investors' rights are protected in an economy, what will happen? Of course, this will protect the business, which will improve the economy, which will increase jobs and whatever we said before. So that's why it's very important. It will help in the growth of the country. When you protect the interest of the investors through corporate governance, it will help to the growth of the country, development of capital market and ownership will improve, the valuation will improve. So all these benefits you can have by implementing the Code of Corporate Governance or Corporate Governance Act. In capital, what is the capital market, by the way? Anybody has an idea what's the capital market? Can you give me an example of a capital market in UAE? So which is the capital market in UAE? Capital market is a market where the companies can generate the capital. And from where the company can, if a company needs capital money, from where they can get the money? What are the options in UAE? If you are in need of money, what can you do?
Apply for a loan.
Or other than a loan, what else you can do? You can sell your shares, right? Where will you sell the shares? In which market do we sell the shares?
Stock market.
The stock market is a capital market, the market which allows the company to generate the capital. That's the capital market. Stock market is an example of capital market. You know, not capital is an investment. So if the company need investment, they can go to the capital market, which means the stock market. They can sell their shares or they can take loan. For loan, they will go to the bond market. In the bond market, they will sell their bonds, which is a type of loan. They will take the loan. And of course, they can go to the banks or they can go to various investment agencies where they can take the loan. So capital market is valuation is very important, and it is the corporate governance which protect the interest of the investors. And when the interest of the investor is protected, you have a better capital market. Like, would you like to go in a market in a country where there is no corporate governance law? Would you like to go and invest in that country? There is no corporate governance. Nobody cares about the interest of the shareholders and interest of the CEO. Would you like to go and invest in that country? Of course, no. So you would like to see as an international financial manager that is the corporate governance properly applied in that country? Is there a protection of corporate governance? Mean the law. What is corporate governance? Corporate governance is a law which basically help us to monitor the relationship between the shareholder, board of director and the CEO. Now, as an international financial manager, you would never like to go to a country and invest your money there where you know that there is no law to protect the relationship between these three parties. So you need a strong corporate governance law in every country so that you are an investor, your interest can be protected. Strong investor protection. There should be strong investor protection. Investor protection happens when there is a proper corporate governance law applied in a country. The government is monitoring it properly. And then you and the other businesses will come and they will invest. So let me just share this case with you because then I will forget and I don't have any other platform. This case is very important for this chapter and I will request you to study it before coming to the next session. There are 3-4 questions at the end, and please try to at least answer these questions after reading the case. I think I can share in this group, right? Do you have my contact number with you? Please, you can note down my WhatsApp.
We don't have it.
Okay, you can note my WhatsApp 0506
Okay.
0506 201767. So I'm going to share this case in the chat box on Team. There are 5 questions, okay? So please try to answer these questions. Here it is. So please download from the chat box. So the case is there in the chat box, so please download it. So this is my WhatsApp and contact details. You can also contact me. Okay, so this is a very important case, and by answering these 5 questions, we will be able basically to cover the entire chapter. We are only left with last few points in this chapter, which we will take after this case, okay? This is the next session. In the beginning, we will discuss the case, and then we have last 3 slides left for this chapter. and then we will move on to the next chapter. So this is, I think, enough for today. I'll stop here. And any question, please, you may ask.
Dr. Khan, with regard to the assignment which was posted a few days back, the word limit 4,000 to 4,500 is count for all 9 questions which has been requested to do. Am I right?
Yes, 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 exactly.
Okay. And
What
will
can
you be discussing?
Yeah, what will we do in our next session? I will go through some of the questions which are relevant to the first 4 or 5 chapters which we have taken so far. I think this is our 4th chapter, and in the next session we will also take 2 more. So we will have 6 chapters altogether, and I will go through the questions which are relevant to these 6 chapters.
Sure, thank you.
I will give the guideline, but in the meantime, you are welcome to discuss with me on WhatsApp, okay? Because we have only 3 hours, so we won't be able to spend the entire lecture on the assignment. I will just guide you that what are these questions and how you will approach to answer these questions. But in the meantime, if somebody is writing the assignment, because we have session only once on Friday. So if you are writing the assignment, you are welcome to discuss with me on WhatsApp. You can call me. However, in the next lecture, I will give you a brief overview of those questions, that how you should answer those questions and to which chapter they are relevant, okay?
All right, doctor. Thank you
But
so
don't
much.
wait for the Friday only. You are welcome to ask me anything on WhatsApp, or you can call me about the assignment, because it's a continuous process. So we will not have enough time on that particular day of Friday, next Friday, where we can discuss the entire assignment with all details, okay? So I can give you the guidelines, of course, for all the questions. Okay.
Thank you.
Okay.
Thank you, Dr. Faisal.
Anything else before we close our session?
Thank you.
Please download this case from the chat box, okay? Okay, thank you very much, everyone. Take good care of yourself. See you next.
Thank you, sir.
Thank you, sir.
Thank you, Dr. Faisal.
Thank you very much.
Thank you, Dr. Khan.
You're welcome.